As the European Parliament is declaring a climate emergency, economists are waiting to see what the response is from the central bank, the ECB. It's another issue that all central banks are having to get involved with. The San Francisco Fed held its first ever conference on climate change earlier this month, where papers presented looking at how it's already slowed US economic output. The Bank of England's Mark Carney has warned the costs of climate change are having a devastating effect on our collective well-being. And Christine Lagarde is reportedly pushing for the issue to be part of a strategic review of the ECB's very purpose. Volker Wieland is the chair of monetary economics at Germany's Institute for Monetary and Financial Stability. He joins me now. Good to see you, sir. Thank you.
Good to see you.
So, just briefly, how is a central bank per se affected and can influence? I can understand it if you're talking about, the assets they buy if they're on an asset purchasing program and what companies and bonds you buy. But besides that, what else economically can or should a central bank do?
Well, first of all, it should keep focusing on its mandate, and the mandate is price stability. So it really should target its monetary policy, fix prices to keep it stable and to keep the economy going. That's the first priority. And in terms of climate change, all it can do is it can look at the risks this poses for economic development, for inflation, and for financial stability. And it should take these risks into account. But it cannot make climate change its first priority.
But on that point, I mean, if your main monetary levers are interest rates, long-term refinancing, or all the usual LTROs and all the usual things, how are they influenced by? I mean, how do you add a climate change component to an interest rate policy?
Well, I don't think they should. I mean, the demand is, for example, that they expect the central bank to shift its purchases towards CO2 emission low companies. I don't think that's a good idea. I think basically the ECB should direct its interest rate policy, its purchases towards the overall economy, keep it stable and keep prices stable. What it should look at is, if climate change poses risks for, certain sectors which may go into decline, and that's an important piece of information for these.
But that would be taken into account in any case, wouldn't it? In the sense that if you realise that utilities and energy production is 5% of your economy, and that is a structural shift because of climate change, which would have an effect on production, ergo, all the usual macroeconomic elements that would be involved. But you're saying, as a matter of public policy, that climate change per se should have only a limited aspect into their calculations.
Well, if you look at financial stability, and there certainly risks could emerge that the ECB would need to look at, either companies which are affected by climate change, or companies and their assets or the debt they have issued, which is affected by policies intended to fight climate change. But it would be wrong to take monetary policy as the main instrument to fight climate change.
So,
we have very good instruments to address climate change. Our council, German Council of Economic Experts, for example, provide the report for the government, and we think what you really need to do is you need to put a price on CO2 emissions from all sectors, either via tax or via emissions trading system, and that can really help mitigate climate change.
Can I just jump in here, sir? What are you hearing from the ECB in terms of, what do you hearing any rumours, gossip out the back door type of stuff of how Christine Lagarde is settling in to the new job? What are you hearing?
Well, I think I'm not hearing much gossip, but she is certainly out with statements. I'm a little worried. I mean, two things. We mentioned climate change. I think it's important to take into account climate change, but it would be a mistake to direct ECB quantitative easing towards climate change. That's not its primary objective. And secondly, she's talking more about fiscal policy than monetary policy. And this creates the impression monetary policy cannot achieve its target without help from fiscal policy. And I think that's wrong, and that would be a problem if that impression really takes hold in the market.
But it's true, but it can't. I mean, how many years now has monetary policy been trying to hit its target of 2% inflation or price stability, singularly failing to do so to the point where the printing presses have had to be stepped up? And even Mario Draghi consistently said fiscal policy had to play its role.
Well, I think they've also talked up the target. So first of all, the target is really below but close to 2%. Inflation measured by the CPI stands at 1%. Core is actually a bit higher. And if you look at other measures of inflation, which take into account all prices in the economy, such as the GDP deflator, we can actually see an updrift over the last few years. And, it's getting close to 2%. So the ECB should stop, pinning only on one measure of inflation, which is the CPI, and they should look at a variety of measures of inflation more closely.
Good to see you, sir. Thank you.